Hello traders and welcome back to the fourth episode of my trading video journal. We are looking at a Bitcoin daily chart, and what I can immediately identify is that on this particular candle yesterday, on the high we reached the previous low here. Let's draw a line. The price almost reached that line. Now it doesn't mean much on the daily chart, but if we are switching to a higher time frame, let's say weekly here, or even monthly, then we can see that on the monthly this was a perfect closure of fair value gap, monthly fair value gap between this candle low and this candle high. Now it doesn't mean that once this gap is closed we're gonna continue down. It can certainly happen, but it doesn't have to. Like in the previous months, when we had a fair value gap between this candle and this candle, we closed it, but we continued higher before there was some sort of reversal. And on another example, we had a fair value gap. We never actually closed it and continue lower. So this in itself doesn't mean much, but nevertheless it's good to observe that this gap is closed now and there is some possibility for a continuation lower. Now if we are moving down to daily chart, and we're gonna remove this line, I am observing a range. So we have the range high, where the buy side liquidity is resting, and we have the range low, where the sell side liquidity is resting. Now if the price goes up, creates a reversal pattern here, then I have a short setup. If the price goes down to this sell side liquidity, creates a deviation, gets back, in other words creates a reversal pattern, then I have a possibility for a long setup. Now what happens if the price in the next few days is doing something like that? Is simply ranging, not reaching not the highest point and not the lowest point of the range. Well, in this case I came up with a plan which involves a strategy with order blocks. So let's explore that order block strategy. We're gonna drop down to 1 hour chart to see our range clearer, and let's open our first order block identified above, and I'll explain how I found it. So the order block is, in this case, the last green candle or the last up moving candle before a sharp drop down. Now, second thing is that on the sharp drop down, the market structure has to be broken. So we had the lows here, these lows, and on this drop, the market structure got broken. So now, once we know that this is broken, we can look for order blocks here. Now on 1 hourly chart, we cannot see any up moving candles here. So let's drop down to 30 minutes. Okay, on 30 minutes, we can see the candle, this and this. So let's mark them just for now. Even higher, including the wick. and this big one here. Now, when we identify those on 30-minute chart, we want to narrow it down and to see if there are order blocks on lower time frames, like 15-minute chart or 10-minute chart or 5-minute chart. So let's do that too. Let's drop down to 15 minutes. Now on 15 minutes, we can see that in this particular order block, it was already mitigated. The price went higher, then the price went lower, and the price went higher again. So this is what is called mitigated order block. It means that in these two particular green candles, price went lower and it went back up to tap into this area. So this one on 15 minutes doesn't count. So we're gonna remove it. But then we see that later on this green candle that mitigated the previous order block, the price left down and it was not mitigated. So we narrowed down all this big region, to a narrower strip. So this 15-minute order block is our unmitigated area where we are expecting the price to tap and to possibly reverse, but we'll get to that. Now on this big order block, we can see that on 15 minutes it can be narrowed down to this wick. So let's move it lower. Now let's check if we can remove it, we can narrow it down even more. On 10 minutes it looks approximately the same. We can narrow it down to here and here. And then on 5-minute chart we can see that this order block was partially mitigated by these two candles. And more to that, on this drop we still didn't break any local market structure, so this one should not even count as order block. On the other hand, this one may count as an order block, because once next candles went down and broke market structure, this and even this, we can mark them here, broken, and even this one broken. So, and then when the price came back up, it still didn't tap into this area. So this one is a valid order block which was not mitigated so far. Now let's remove this to keep it clean. So we can remove all this big rectangle and keep only the smaller, narrower rectangle, and I already marked it as a 5-minute order block. So what happens next? Once I identified the order blocks above me, I will expect the first one to be tapped. So I'm gonna set an alert just before it. And once price arrives here and I will be alerted, I want to switch from a higher time frame, like 15 minutes, into lower time frame, something like a 1-minute time frame. So here I want to see a market structure shift. I want to see that some previous local low is being broken and that the price comes back either to close some sort of fair value gap in this area, or if a new order block will be formed here, we might have a tap into it. And this will be my short setup with stop loss above the order block high. Now, in this particular scenario, let's imagine that the price progresses exactly like this. Now, my first take profit level will be the first market structure change here, like first pivot. So this will be my take profit 1, and the next one here will be my take profit 2, and the last one perhaps will be at the lows of this area, or some next lows that are going to be created. Perhaps the price goes lower here. We'll see. So as you can see, the risk to reward can be quite lucrative. So I'm gonna take 25% of my position here, 25% of my position here, and the rest of the position will be targeting some lower liquidity in the area of these weeks, or maybe even lower. Now, what happens if the price arrives here and it does not create this market structure shift? Well, in this case, the price will basically go straight to it, and in this case, this is not a trade setup for me. I'm gonna wait for the price to arrive to the next order block, and again do the same. If there is a change in market structure, then I have a trade setup for me. If there isn't, however, something like that, if there isn't change in market structure, price keeps going higher, then I pursue my original plan of taking a short from this buy-side liquidity. Now let's check the order blocks below the current price. So I identified one on 10-minute chart here. This last black candle, but with including the wicks, before the price proceeded higher. And as we can see, it still was not mitigated. The price didn't dip into it, so it's still an unmitigated order block. On the contrary, this order block here, this black candle, last black candle before the move up, this one was already mitigated by this newly created order block. So how is it helpful? If the price arrives here, creates a reversal pattern, this is my long. If the price goes straight through the level, I will not be even concerned with this particular low. I will not be looking for a long setups based off this order block, just because it was already mitigated. What's gonna happen is I'm gonna wait for the next order block, which was not mitigated yet. Here in this area, let's check it out. So we see last order blocks below. If the price goes through the first one, then I have a potential long setup on this order block or on the lower one. Now, the beauty of this strategy is that I know at which level I want to look for any kind of reaction, and once the price arrives there, I know what to look for. I want to look for a reversal pattern, some kind of Wyckoff accumulation or distribution pattern, which signifies a reversal where I can enter a trade. If it does not appear, then it's very simple. There is no trade setup for me, and I'm waiting for lower on the order block, or if there is no reaction even here, then lower at the bottom of my range. So These are my trade ideas, perhaps for the next few days, maybe even a week. I will not be recording the screen while the price progresses, but I will be placing alerts in front of the order blocks here above and here below. And once the price arrives to one of them, then I will be jumping in front of my computer. I will turn on the recording and will act accordingly, either take a trade or let it pass. And after a few days of action, or maybe a week of action, I will finish the recording, edit everything, and we'll see how my whole big plan of establishing a range and also trade setups within the range, how this whole plan progressed. So let's see how it goes. So the price dropped to the order block, and now we want to see here a reversal on a lower time frame. So let's switch on the 1 minute chart and observe what happens here. So now we have a clear market structure break. So we want to see a return down here to close this fair value gap, and subsequently also to revisit this last unmitigated order block. So this will be our area of entry. With stop loss below the last wick and targeting liquidity above here. So we've got our entry. If indeed the bullish momentum is correct, then I expect this previous high to be taken out and a hunt for liquidity above this high to be proceeded. So my first TP will be here. It will be my TP1. Next, if we take out this high, I would target this high next. It's an overall high of this trend. Indeed, if the bullish scenario continues, then this high will be hunted next. If TP2 is reached, I would like to hunt next this low, because once we are leaving this range, all these highs, then the next thing to be left will be to go up and to close all these gaps and perhaps to reach our higher order block. So this will be our TP3. The possibility is that the price is coming back to revisit this newly formed order block, either on 5 minutes or let's see if we have some other lower time frames order blocks. So it could be this one. the price came back down to mitigate this order block, and it continues to move higher. And I guess once it is mitigated, we should not expect the price to come back down here. So once the price moves higher, it might be safe to move the stop loss to break even level or slightly below. That's my gut telling me right now, but let's see how it progresses. Alright, so seeing the price bouncing off of this order block, I will go with my gut, and now I will move my stop loss to break even. So take profit 1 and take profit 2 was taken, sadly take profit 3 was not reached, and I got stopped out on the rest of my position. So let's review the first trade of this session. The entry was taken from this 10-minute order block after I've seen that the price came down, bounced, and returned to close the gap. Then take profit 1 was taken. Later during the night take profit 2 was taken, but take profit 3 was missed. The price returned and I got stopped out on the rest of my position. Now what I notice right now is that I could bring the take profit 3 lower. If we are simply using a range tool, from high of the move to low of the move at that time, then we can see that the price reached exactly 0.5 of the range. It's the middle of the range. And additionally, we are moving to 15-minute chart, and I use on this whole decline a fixed range tool, and I can see that the point of control, or is known support resistance line of the range, is also in this area. So these were the two tools that I could use to determine take profit 3. Unfortunately I did not do it, and my take profit was higher in the golden pocket area of 0.618 to 0.66 Fibonacci levels. So apparently this level was better. And now I'm going to review the second setup that presented itself. Once the price broke down from this order block, we had another order block below us. The price almost reached it here. Now I was expecting lower, therefore I did not take the trade off of it. However, what I did notice is the change in market structure in the area where I was expecting a bounce. So once we broke down, this was the first low, this was the first local high, then we broke below, broke above, creating shift in market structure from bearish to bullish, and on this return into fair value gap here between this candle and this candle on a 5-minute chart, this would be the optimal entry. Now the take profit could be either here, closing, expecting the price to close this fair value gap, expecting the price to close this fair value gap here, or even higher, targeting the next order block. And this would be a valid trade setup and a profitable trade. Now, what I discovered later is that within order blocks I can refine my entries or find another level which, well, in this case and on my other tests, are being reached perfectly, at least on Bitcoin USD chart. So this dotted red line here and here, if we are going back to our order block, this dotted line is a point of control of the order block. If we are using this tool, you can see that the majority of the volume was in this area. So once I drew this dotted line to see if we actually reached this level or if we bounced from it, turns out that we reached it exactly here. Here. Turns out that on our previous trade, on the setup number 1, we reached that level exactly. I found out only later that this point of control, the fixed range, can be so useful. And later on, after we broke out of our range completely, I can see that we also reached the order block, the point of control of the order block below, also exactly to the dollar here, and had a huge bounce. Next thing, lower, also here we reached the order block and bounced off of it. So this is something I'm going to test more and more, because as we can see, we had an approximate area of the order block based on 10-minute chart. However, the price didn't reach it. From now on, I'm going to use both tools, just the candlestick pattern to define the range of the order block, and the fixed range volume tool to define the point of control, where, as far as I can see, bounce is likely to appear from. So let's summarize this session. What did I do right? Well, apparently I did create a good plan with trade setups which were reached. So correctly identified potential trade setups based on the order blocks. Obviously, I took a profitable trade. And I also avoided taking losing trades, because in other instances where the price, let's say, reached this order block, there was no reversal pattern and the price broke completely through this previous low where the sell side liquidity was sitting. So no reversal pattern here, didn't take this trade at all. Avoided. Taking losing trades. Now, what did I do wrong? Well, on the first setup, the take profit 3 was identified incorrectly. First trade. The last take profit was identified incorrectly. Next thing, I did not take this trade just because I was expecting the price to really reach the gray rectangle of the order block. Now, this didn't happen, at least not on this trading pair. Although what did happen here was in the area where I was expecting a potential trade setup, there was a market structure shift, so I should have taken the trade from here. So I guess I was too picky about price reaching the exact setup area. Now apparently this rectangle was simply drawn incorrectly. It could have been higher if I was drawing it based on the 5-minute chart. So I should take into account that sometimes it will not be drawn correctly. So I should expect some sort of grace area above or below to take into account. So basically to look for the break of market structure or change in market structure also above it. Now, the last thing which was wrong about this whole session was that somewhere in the middle of the week I got really distracted with studies of new material about order blocks and about imbalances that I did not really follow what was happening here closely. So I guess, yeah, the simply lack of focus on my own plan. During the week. Okay, now what new things did I learn in this session? So, first of all, I discovered that this point of control of the order block is quite a useful level. I can actually take limit orders, trades based off of it, and certainly it can be used as a confluence when I see that the price is reaching that level and I'm expecting that level to provide some sort of price reversal and a trade setup. But when I see that the price is reaching this level and bouncing off, it certainly provides a good confluence for my trade setup. So POC, fixed range tool in combination with the order block provides good confluence on my trade setup. Now, the next thing that I learned during this whole decline is that not all gaps, like here and here, and not all order blocks will be revisited before we continue lower. So it basically shows that the market is too weak even to make a significant retracement higher to close the gap or revisit the order block. So this is just a sign that the market is really bearish. The price does not revisit the gaps or the order blocks. It means that the market is extremely, well, in this case, extremely bearish. And the last thing for this session that I learned is this newly formed order blocks upon revision of the price. So in my first trade we had this trade setup based on the fair value gap, and then when the price shoot up higher and came back down, it revisited the order block. So what I could have done was taking larger percentage of profits in this take profit 1 and then compounding them when the price revisited the order block. Or I can use it also as a separate strategy of entering a new trade on the revision of the order block, of the newly created order block. Basically it ties into discovering new trade setups based on the information that I'm learning here. Newly created order blocks can provide new trade setups and should also signal to me that I cannot move my stop loss to break even if the order block remains unmitigated. So this is the summary of this session. During this week I also studied a lot, watched a lot of videos, studied some new material, which a bit distracted me from my own research and from my own recording, but it also provided quite a lot of avenues for the new videos and for the new research or deepening my overall understanding of how I can apply ICT on crypto and in my own trading strategy. So I guess it's just natural progression of trying new stuff, and in the middle of it being exposed to another new stuff and trying that out and mixing and matching all that new information and processing it slowly. Alright, thank you very much for watching, and I'll see you in the next video.